All right, guys, we need to talk about Tesla's Q2 2025 earnings that dropped yesterday on July 23rd because these numbers tell a pretty complex story. Revenue down 12% year over year to $22.5 billion. That's the biggest decline in over a decade for this company. Net income dropped 10.3% to $1.2 billion. Now, they did beat analyst expectations slightly, which shows the market was already pricing in some challenges. The interesting part is Elon's warning about rough quarters ahead, which is unusually cautious language from Tesla leadership. What really stands out is that Tesla pulled their full-year delivery guidance back in April and still hasn't provided an updated number. This could indicate they're being more conservative with projections, or it might reflect genuine uncertainty about market conditions. The macro environment is definitely challenging for automakers right now, and Tesla is clearly feeling those headwinds. But what makes Tesla's situation unique is how they're positioning this transition period. They're essentially asking investors to look beyond current automotive challenges toward their AI and robotics initiatives. The question becomes whether this strategic pivot can offset the near-term automotive business headwinds we're seeing in these numbers. Here's where Tesla's strategy gets really fascinating. They're making a massive strategic shift toward robotaxis and the Optimus humanoid robot. The robotaxi service launched in Austin, which represents their first real-world deployment, with expansion planned for Florida, Nevada, Arizona, and California. Musk mentioned that Tesla owners might be able to add their cars to the network next year, which could create an interesting new revenue stream for existing customers. The Optimus development is particularly intriguing. They released this video of the robot serving popcorn at a Tesla diner, and the V3 version is already running Grok AI from xAI. When I saw that demonstration, it was pretty impressive to see how far they've progressed from early prototypes. Now, there have been some leadership changes in the Optimus program, which is fairly normal for ambitious development projects, and Musk is promising a major demo by the end of the year. The big question is execution and timeline. Analysts are projecting potential revenues of $75 billion from robotaxis and $250 billion from Optimus by 2030. Those are substantial numbers that would completely transform Tesla's business model if achieved. The challenge, of course, is turning these demonstrations and limited deployments into mass market products. There are significant technical and regulatory hurdles to overcome, but the potential market sizes are genuinely enormous. It's basically Tesla betting that the future of transportation and automation is going to be very different from today and positioning themselves to capture that transition. Let's look at what's happening in Tesla's key markets, because the competitive landscape has definitely shifted significantly. In Europe, Tesla has seen market share decline for 6 consecutive months through June, with Volkswagen and Chinese competitors like BYD gaining ground. European sales were down 33% in the first half of 2025, which reflects both increased competition and changing consumer preferences. What's particularly interesting is the situation in California, Tesla's home market and the largest EV market in the US. Q2 deliveries were down over 20% compared to last year, marking 7 consecutive quarterly declines. Tesla's market share in California dropped from 55.5% in Q1 2024 to 43% in Q1 2025. This suggests the competitive dynamics are intensifying even in their strongest markets. In China, Tesla actually saw a bounce in June thanks to the longer Model Y version, but their overall market share has declined from almost 15% in 2020 to around 6% recently. Local manufacturers like BYD have really ramped up their capabilities and market presence. What's happening here is pretty typical for maturing markets. Early leaders face increased competition as the technology becomes more standardized and other players catch up. Tesla used to have significant advantages in areas like software, charging infrastructure, and manufacturing efficiency. While they still lead in some areas, that technological moat has definitely narrowed as competitors have improved their offerings. The question becomes whether Tesla's pivot toward robotaxis and AI gives them a new competitive advantage, or whether they need to compete more directly on traditional automotive metrics like price, features, and availability. There are some important policy and market dynamics worth considering for Tesla's near-term outlook. The $7,500 EV credit is set to expire by the end of the quarter, which will effectively increase Tesla's prices for many buyers unless they find ways to offset that cost. Tesla has historically benefited from regulatory credits, selling emissions credits to other automakers, but that revenue stream is expected to decline as other companies increase their own EV production. In their Q2 report, Tesla specifically mentioned shifting tariffs, unclear impacts from fiscal policy changes, and political sentiment as challenges they're monitoring. This reflects the broader uncertainty around EV policy and incentives that many automakers are facing. There have also been discussions about how brand perception might be affected by various factors, including leadership associations and market positioning. The EV market has historically attracted environmentally conscious consumers, and any changes in brand perception could influence purchasing decisions. The policy environment for EVs is definitely evolving, and Tesla will need to navigate these changes while maintaining their market position. This includes adapting to potential changes in government incentives, trade policies, and regulatory frameworks that could impact both manufacturing costs and consumer demand. The challenge for Tesla, like many companies, is operating in an environment where policy support that helped establish the EV market is potentially shifting, requiring them to compete more purely on product merit and value proposition. And Tesla finds itself in a really interesting strategic position right now. On the automotive side, they're dealing with increased competition, market share pressure, and policy changes that create near-term headwinds. But simultaneously, they're investing heavily in what could be transformational technologies, autonomous vehicles, and humanoid robotics. This creates a unique investment dynamic where you're evaluating both a traditional automotive business and a speculative technology company within the same entity. The long-term vision of autonomous vehicles and robotics is genuinely compelling from a market opportunity standpoint. If successful, these technologies could create entirely new business models and revenue streams that dwarf traditional automotive margins. The challenge is execution and timing. Can Tesla develop and deploy these technologies while maintaining their core business through this competitive period? Their production targets are ambitious, aiming for 2.5 million vehicles in 2025, while simultaneously investing billions in robotaxi and Optimus development. The transition period is inherently risky because Tesla is neither purely an automotive company nor yet a proven AI/robotics company. They're somewhere in between, which creates both opportunities and vulnerabilities. From an investment standpoint, Tesla represents a pretty unique proposition in the current market. You're essentially investing in a company that's undergoing a fundamental business model transformation while maintaining operations in a highly competitive traditional industry. The core question becomes whether you believe in Tesla's ability to successfully commercialize autonomous driving and robotics technologies. The potential market sizes for these technologies are substantial. Autonomous transportation and humanoid robotics could represent trillion-dollar opportunities over the next decade. Tesla's integrated approach, combining vehicle manufacturing with AI development, gives them certain advantages in developing these technologies. However, there are significant execution risks and competitive factors to consider. Regulatory approval for widespread robotaxi deployment remains uncertain, and the technical challenges of general-purpose robotics are substantial. Meanwhile, Tesla needs to maintain competitiveness in their core automotive business during this transition period. Traditional valuation metrics become challenging to apply because Tesla is essentially two different companies in one: automotive manufacturing manufacturer and an AI/robotics developer. The automotive business provides current cash flows, but faces competitive pressures. It's a complex risk-reward calculation that requires evaluating both traditional business metrics and speculative technology potential. Tesla definitely isn't a conventional investment. It requires active monitoring of both operational execution and technology. Development progress across multiple, very different domains. So if you found this analysis helpful and want more deep dives into companies navigating major transitions like Tesla, make sure to hit that like button and subscribe to the channel. But remember, everything I've shared here is just my opinion and analysis. This is not financial advice. Tesla is a particularly volatile and speculative investment. So always do your own research and never invest more than you can afford to lose. See you in the next one.